Back to then, the money show. We had the June AMFI numbers that were released. It showed a very, very starking trend, very surprising one as well, wherein the net inflows into equity mutual funds crashed and how to just a meager 240 crore rupees. This, of course, is a big, big fall, a more than 80% fall on a month-on-month basis. But we further bifurcated or dissected down into categories. The multi-cap category is something that has seen the maximum amount of outflow, net outflow rather, of more than 700 crore rupees. But interestingly, the categories that have been really whacked out of shape in the last 2 months, and that's largely been the likes of a small cap and a mid cap fund, have seen some interest, or well, let's not call it interest, but just some sort of resilience. ELSS as well has picked up a lot of interest, perhaps given the fact that we just had the last 2 weeks left, for those tax saving investments for FY20. So that may be a reason why the ELSS fund inflows have been constantly increasing. But we'll take forward this conversation with Mr. Harshvardhan Roongta. Harsh, apologies for keeping you waiting, but thank you so much, for patiently waiting by. What do you make of this entire movement in fund flows that we've been witnessing? First up, I want to talk about multi-cap funds. As the name suggests, it invests in an array of large caps, small cap, mid caps, etc. But there's been a very sharp net outflow in multi-cap funds, indicating that perhaps people have been redeeming money from multi-cap funds in particular, even large cap funds for that matter, quite the opposite to small and mid caps. What are you making of this trend?
Well, Nobita, you rightly pointed out that the numbers that have come out for June 2020 have been very, very scary. I mean, it's not really normal. But given the specific question as to why do we see the redemptions more in multi-cap and large caps, and the inflows being going into mid and small cap funds? Well, perhaps the reason could be that when the markets are in a volatile zone, when we talk about markets going down consistently, we notice that investors find the large cap category and multi cap for that extent to be safe havens within equity. So naturally, when the market's on a downward trend, the mid cap and small cap will take far more beating than what a large and multi cap will do. So now, having said that, now when we look at where we are from the bottom that we hit in the month of March 2020, we're almost 35 to 40%. Already markets have gone up. So this also is a very normal trend when we see that investors actually look at what returns have been in the recent times. So it could be as recent as even 1 month or 2 months for that matter. And then they feel that mid and small caps have started doing very well. So why not shift the focus towards mid and small caps? So this possibly explains why do you see a negative inflow into the large and multi caps, and perhaps a positive inflow into mid and small caps. So here again, the situation is such that investors seem to be looking at past returns and pumping money into these particularly two categories.
But that would be a problem, right? I mean, think about it. You have your funds already parked in, the multi-cap fund. You may already be bleeding over there, and I think that would be the case, of course, with a lot of long-term investors in mutual funds. So imagine that your multi-cap MF, where NAVs perhaps may be in the negative, or maybe the profit has come off very, very sharply, and then you go ahead and redeem, your funds over there, and instead park it in funds that have, maybe seen a bit of a bounce. Of course, if you're long-term investors, really, these 1 month, 2 month bounces shouldn't matter. But don't you think this is actually just fundamentally wrong?
Yes, absolutely. So in fact, when we talk about long-term investing, we talk about portfolio creation. So we're not talking about investing for the next couple of months. Equity investors are usually investors who will invest for long-term goals, which could be 5, 10, 15 years away. So when you're creating a portfolio, you cannot create a portfolio looking at only a couple of returns that have come in the last couple of months. A portfolio creation actually entails your allocations towards large, multi-cap, mid, small caps, depending upon what is the time horizon you have, what is your risk-taking ability. So if you are a conservative equity investor, you will not invest a large amount of your portfolio into mid and small caps. So yes, it's fundamentally wrong that you will see this kind of changes being made, especially during such challenging times when the markets are in a volatile zone. There's a lot of uncertainty going around otherwise. So this is not the time to change your asset allocation strategy. I would recommend that investors should stick to their asset allocation. So in case you decided that a 50% should be in large cap, probably a 30% in mid caps and the others into some multi-cap otherwise, stick to that. Do not change that only because there have been exponential returns in probably mid caps in the last 1 or 2 months. So yeah, yes, Mobina, you're right that we should not look at restructuring our portfolio given the market conditions over the last 1, 2 or probably even 1 year for that matter.
All right. Harsh, we often say that one must review their portfolio every now and then with a good frequency, maybe once in a quarter, once in 6 months, once in a year. So during this review process, you mentioned just because a particular fund has given extraordinary returns and the other one has not really done well, that does not mean that you sort of, trim down your holdings in that fund and, increase it in mid and small cap funds. So what should be, the telltale signs of when you're reviewing your portfolio? What should then you look at if not past returns?
So there are a couple of factors. In fact, it starts with the allocation towards large cap, mid cap, multi cap, sectorial, thematic funds. So it starts with that in the first place. So when you're thinking to construct an equity portfolio, you will think how much of your investable amount which goes into equity will go into large caps, how much will go into multi cap, mid, small, thematic sector, etc. Now you started investing with that and you selected a couple of schemes within this each category with this allocation as decided. Now, probably after a year or 2 for that matter, not before that, I don't think you need to make any changes within 1 year itself. So if you're an SIP investor, there is no point in looking at returns that your portfolio generated without this other peer group and the benchmark within 1 year. So you will give time for about say a year or 2 at least, and then you will take a review. Now, what kind of review you need to do? You need to compare a large cap with a large cap itself. What usually investors do is they look into their portfolio. So because the portfolio also has a large cap scheme and a mid cap scheme, they will tend to compare a large and a mid cap within their own portfolio. So that is wrong. So there you will possibly find a mid cap giving you a positive 12% and a large cap giving you a plus of say about 4%. So what usually an investor thinks, I shouldn't have invested in this large cap, I should have invested in this scheme which is performing at 12%. So that's a wrong comparison. You have to compare a large cap with a large cap, a mid cap with a mid cap. So that is the first level of filtration that you need to do, which usually investors tend to get it wrong. Then the other level of introspection that needs to be done is if while starting you had allocated 50% to large caps maybe. Now your risk appetite has gone up, or there has been some financial changes in your life which enable you to take more exposure into mid caps. Then you may want to change the allocation between large, mid and small caps as we have spoken about. So 2 ways that you will have to make this evaluation. The triggering point would be one, of course, a timeline that you've decided that I will look at evaluating my portfolio probably after 1 year or 2 years. So you have to wait until then. The other triggering point would be if there is a fundamental change in your own lifestyle. If you were employed in a particular company, now you've changed and you've become self-employed, or you've changed, your incomes have gone up or gone down, then you may want to review. It could be even within 3 months after having done this. So there has to be a fundamental change in your own lifestyle. The third review, the possibility of review you will do when the scheme that you invested into has horribly gone wrong. If there is something that has gone wrong and it has been highlighted to you, then you may want to sit and review it irrespective of the timelines that you've chosen, irrespective of any fundamental change in your own lifestyle. So these are the trigger points. And in all of this, I haven't spoken about a trigger point being market volatility. So right now, what investors tend to get wrong is that because there is volatility in the market, they will sit down and try and review it. That's not the parameter that you should be looking at.
All right. Okay. That's very important, because I just want to like flag off that one point that Harsh mentioned. The tendency is that when we have, let's say, an SBI large cap, hypothetically, and you have an HDFC mid cap fund, what you do is you compare the return by the SBI large cap and the HDFC mid cap, and whichever one you're not pleased with, you tend to redeem that. That's actually not the way to go. You compare an HDFC large cap with an SBI large cap. Similarly, you compare the HDFC mid cap with maybe your Axis mid cap, so on and so forth. So you have to actually look at it within categories and then decide which one's working for you and which one's not, with the help, of course, of your personal financial advisor. Well, you know what? After this very, very quick break that we're going to take, we're going to get some questions and queries answered. I'm also going to get in Harsh's opinion on the surge in retail trading activity. So all of that is lined up. Harsh, request you to stay on. Quick break right here on the show. Welcome back. You're watching The Money Show on ET Now. We're in conversation with Harshvardhan Roongta. We were speaking about way to essentially look at the different categories of mutual funds that are in your portfolio. And now we'll take on board some questions and queries. We received quite a few of them, so let's get straight to it. First up, Siva Kumar emails are saying that he's been investing in a couple of funds, namely the Murray Assets Tax Saver Regular Plan, SBI Magnum Multi-Cap, the Canara Robeco Small Cap, and the Axis Long-Term Equity, as well as the Tata PE Equity. All of these SIPs are for the long term. So there's a multi-cap fund, there is a small cap, and then there are large caps, and as well as an ELSS. There's roughly well, you could say around 14,000-15,000 rupees as a SIP that he is investing. Unfortunately, all he's written is that it's for the long term, so we would assume that he just wants to save up for his retirement or any other reason. What do you make of these funds, Harsh? Is he in the right direction? Is his bifurcation across these funds allocation correct?
So by and large, the portfolio looks fine. I mean, there is adequate exposure that he's taken into different categories. So he has a value-oriented fund. Of course, the multi-cap approach tax-saving funds, and he also has a small cap fund. So I just want to make one small change in his portfolio. The quantum that he's investing into Canara Robeco small cap is about 3,500 right now. I suggest he reduce that to 2,500, and this 1,000 that is left then get invested into a multi-cap fund in his existing portfolio, which is an SBI Magnum multi-cap. So besides this one change in the quantum, I'm not recommending any change in the scheme as of yet, and just one change in the quantum so that the allocation becomes more towards multi-cap and it reduces towards a dedicated small cap fund. All the other things are fine, and we can continue as it is.
All right, so largely the portfolio looks pretty okay. That's, Harsh's recommendation and his review of the portfolio. Now next we have Santu Mondal, who's writing into us saying that he has started a SIP of 10,000 rupees into the UTI Nifty Index Fund, and he in fact wants to hold on to this investment all the way till 2050, because that's when he is retiring. Now he wants to know what should he do? Should he just stay put in this SIP that he's doing and continue it? He's asking about your opinion as well, I think, on doing SIPs in index funds. The market as well has rallied, so his question is, should he consider booking some profit? Harsh, I'm sure you've been asked this question. The plan is for 2050, but then again you get tempted because of this short-term rally in the equity markets.
For Mr. Mondal, there is no need to in his portfolio. In fact, investing into an index fund is one of the best ways to take exposure into the markets. It's a well-diversified portfolio. Representation in the indexes from all the sectors of the economy. The costs are usually lower. So there is no need for him to do anything at this juncture. He's investing 10,000 rupees a month. I think he can simply continue investing till 2050. And the second question, whether he should book profits, well, I wouldn't really recommend that. The goal is the long term. We're looking at growth in the economy over a longer period of time. There is no need to book profits now and curtail your gains at the potential.
Actively management, but at this juncture all is fine. Just continue as it is till 20.
The range that we are witnessing, I think we've managed to get Harsh back on the line, and I hope, Santu, you've got gist of what exactly Harsh is trying to explain when it comes to your portfolio. All right, let's very quickly take on board one last query for the day. It's coming in from Nagesh. He says that I'm 35 years old, my wife is a homemaker, and I have a daughter who is 5 5 years old, pardon me, I just thought I read 15 over there. He says his monthly savings are roughly 30,000 rupees. He's got an LIC policy of 1 crore, another that's a term insurance from HDFC. He's got a good Mediclaim as well, 5 lakhs provided by his employer, 5 lakhs purchased externally. He's got an EPF of roughly 1.3 lakhs per annum. He's got his emergency corpus as well set, 6 lakh rupees parked away in a liquid fund. Now that 30,000 rupees, he split it up with 70% in equity, debt 25% and gold 5%. He's got his retirement plan on the anvil where he wants to save 25 to 2 crore rupees. He's got his kids graduation, or he wants to put in about 10 lakh rupees for post graduation, 30 lakhs, marriage 10 lakhs. Then large cap is 15% of his portfolio, multi cap is almost 50%. That's basically through an NPS. He's got a little bit in an international fund as well, and he's got another 4,000 going in a PPF, 3,500 in an NPS. So he's charted out his his plan, his financial plan in an extremely organized and perfect way. Now he wants to know if its current asset allocation, which is basically 70, 25 and 5%, is that a good allocation to go? Is his monthly SIP amount as well enough to reach his goals? Should he be changing anything in his funds? He also recently replaced a large cap fund in the portfolio with an index fund. Was that a wise thing to do? And then of course he's got his ATC investments. I think Harsh will largely agree with me that this is a gentleman who's covered every corner, right from of course making long-term investments in equity mutual funds to even taking care of your emergency fund.
It's a very meticulously designed portfolio. So it's it has got all the nuances that we talk about a good financial plan. So he's identified all his goals, right? What does he require? He's quantified them, and he's also got a clear timeline to it. So these are the basic ingredients of a good financial plan. The asset allocation mix: 70 equity, 30 debt. Within 30, of course, he has 25% in pure debt funds and debt financial assets. 5% in precious metal, which is gold. So I think all the nuances of a good financial plan are already inbuilt in this. With regards to his other queries that he has, is the current asset allocation perfect? Yes, 70-30 is a good ratio to have. Insurances are in place, so I'm not commenting on that. He has a concern whether his current SIPs, the amounts that he's investing, whether that will help him meet all his targets. So I did just a bit of calculation. The weighted average portfolio returns, if we take at about 10%, he's likely to meet all his goals that he's set out. So he's got retirement, education, marriage, etc. I think all that can be met with about this kind of investment that he's doing. Does he need to make any changes? Because he has a question very specifically asked about it. So, I don't personally. So he has one dedicated small cap fund, which is a Reliance small cap fund. I personally do not recommend a dedicated small cap fund. So if you invest in a multi-cap fund will automatically cherry pick the best of the mid and small cap companies that they find valuable to invest into. Whereas if you have a dedicated small cap fund, the fund manager is mandated to have primarily the entire portfolio of small cap companies, whether he or she likes to invest into them or not. So I prefer a multi-cap approach rather than a dedicated small cap. So possibly you could make one change over here and include a focused fund. So it's a multi-cap approach with a concentrated portfolio. So an Axis focused fund will be a better choice as compared to having a dedicated small cap fund, which is in this case the Reliance small cap fund. So that change he could make in his portfolio. With regards to his question about whether he should continue, was he right in changing his scheme in the large cap category from an actively managed to an index fund? Yes, we did speak about index funds. So they're very good investment options, especially in the large cap category. So most certainly no harm in doing that. With regards to his last question, which was that he's covering all his ATC requirements by investing to PF and term insurance. So is there any change in requirement? Not really, because PF is a very good debt investment and term insurance is something that he requires. A combination of these two, if is fulfilling all the needs for the ATC deduction, there is no need to do any changes. And in fact, that leaves him with all other investments to be done for absolutely the way he likes it, without having any restrictions to invest for tax purposes. So well, I think he's doing well so far. And just one more addition into his plan part. He's doing everything perfect right now. The only one thing that he should keep in mind going further is, in case his income goes up, make sure that a portion of that income also gets invested. So your investment should increase proportionately as much your income goes up every year. So that will ensure that you really create a sizable amount of wealth for yourself and meet all your goals in due course.
Right. Well, there you go. That's a comprehensive review of your portfolio by Harshvardhan Roongta. But with that, we're out of time. So, Harsh, really appreciate you once again for joining us today on The Money Show and helping our viewers out with their queries. We'll wrap it up. Stay tuned for Startup Central.